Welcome to the Well-Rounded Retirement Podcast with John and Jim from CRIS Financial. In this podcast, we help you take a well-rounded approach to retirement planning so you can retire with complete certainty. If you're looking for proven and straightforward retirement advice, ranging from how to protect your assets to how to spend with confidence, this show is for you.
Hello and welcome to Well-Rounded Retirement with Jim Donewald and John Glowacz from CRIS Financial. Gentlemen, how are you?
We're doing really, really good today.
Today's a good day.
Today is a good day. Man, audience, let's be honest. We've been chit-chatting for 5 minutes before we even start recording. These guys are a riot. If you have not met them in person, I can't imagine. I haven't met them in person yet, but I'm looking forward to it because they're just fun. Okay. Sorry. It's been fun so far. Anyway, so
we
this
sent
podcast,
you some pictures.
True, you did. And you guys look amazing, by the way. I mean, for your age, it's just kidding.
Thanks.
Thanks.
You're welcome. You're welcome. Now that I'm fired, let's just finish my last podcast with you guys. Today we're starting a series. I'm really excited about this. You have kind of termed it the solution series. And if I hear solution, that means there's a problem. So what problem are we addressing today?
Well, we're going to want to talk about the market in general, the volatility with everything that's going on. And really what we try to do is give our clients an unfair advantage in retirement. Mm-hmm. I like to position John and I as kind of like your Sherpa. And if you don't know what a Sherpa is, that's the guy that helps you get up and down the mountain safely. And any good Sherpa knows that 90% of the accidents happen on the way down the mountain. Mm-hmm. And so think of your retirement as accumulation is all the uphill going along. And now that you're at the top of the mountain and you're looking at retirement, we want to be your guide and help you through that. And for us, it's all about a plan. And we can talk about products, and that's certainly part of what we do. But there isn't a product that I found that's going to save anybody's retirement. It's all about a plan and a process. And the products change all the time. And what John and I have developed is a process to help our clients get down that mountain safely.
Yeah, and as far as Sherpas go, I can tell you from firsthand experience, these guys look great in yak pants. I think that's the modern version of what the Sherpas are wearing these days. Maybe not. I don't know. Please, if a Sherpa's listening to this, I'm not trying to insult your traditions. That's not my intention at all. I apologize. But it leads me to my question. You're talking about market volatility for retirement and people getting close to retirement. Even me, I'm not even close. But at this point, should my plan even include the market because of the volatility that we've seen?
Yeah, that's a great question. We get asked that all the time here. And John and I, we love the market. I have nothing against the market, but there are some limitations to what you can do. And mostly what it comes for us is, since our clients are right on that threshold of retirement, is they can't afford the lot of volatility, at least for the money that they're going to require in, say, the first 10 years of retirement. Mm-hmm. And so, John and I were talking, and John, remind them what happened March 16th of this year.
Let's take a look at March 16th. And in this case, let's just pretend that you woke up that morning and you had a retirement account balance of $500,000 beginning at 8 a.m. that morning. And by the time you reached the end of the day at 5 o'clock, your account would have been worth only $435,000. The translation is that we lost $64,500 in just one day. So now let's do the math as it relates to your retirement account and what kind of effect this kind of a loss would have on your retirement income, just using the standard 4% rule. So if we would take that 4%, multiply it out by 500,000, that would probably produce $20,000 per year in retirement. So what happened on that day in March is that we lost $64,500, and that $64,500 is gone. And with it was 3 years of income in just a little bit less than 9 hours. Now, Eric, I don't know about you, but that's scary, especially if you're in or near retirement.
Yeah, I can't imagine being in that position, quite honestly. Luckily, I'm not in that position yet. But for those that, they've kind of mapped this thing out, right? They're going to spend more time with their grandkids. They're going to be, maybe they're, looking at a second property, a vacation home, or being able to travel a bit more. And then all of their plans kind of get shaken a little bit, and that can be pretty scary. So how do you guys help your clients, realize that market volatility happens, but at the same time not be fearful of it?
Well, what we want is our clients, we want their actions to match their goals. So many times, what drives the market, everybody knows, is fear and greed. They either think they're missing out on the gains or they get scared when it falls. So we want people to have a plan so that doesn't happen. We teach a college course up here, and one of the things is I tell people to make their plan is, let's assume I'm a pilot here, and I'm on the runway, and the plane's all gassed up, and we're ready to go, and I welcome everyone aboard, and I say I have no idea where I'm going or how I'm going to get there, how many people want to stay on that plane. Yeah. That's the problem if you don't have a plan. So how are you going to get to where you're going if you don't know where you're going?
Mm-hmm.
That's the big thing. And so what we try to do, at least for the money that we're going to need sooner versus later, because the first part of retirement is the most important. If you have a big market correction in the first 10 years, it has a much more negative effect than obviously than if you don't. So we want to protect that money near retirement. And so we like a couple of different plans. One that we use is a simplified accumulation annuity. And John, you want to tell us a little bit about what that entails?
Okay, on simplified accumulation annuity, basically Jim and I both look and we take 4 steps and 4 critical steps that we think will allow you to increase your retirement income, increase your growth and your accumulation even during an economic crisis. The first step is that we want to identify and eliminate fees, and we're going to show you how recessionary activity makes the fees much, much worse than they seem during a bull market. Mm-hmm. The second step that we talk about is that you need absolutely to protect your downside. A lot of us have more risk than we think we do, and we should be mitigating some of that risk with downside protection. And the third step that we talk about and that we cover is how to position yourself for the bounce back, because this too will come to an end, and when it does, you need to be positioned properly for the bounce back while protecting your downside. And the last step that we talk about in our solution is we're going to show you our strategy for calculating and generating what we call calculating maximum income, where you can increase your annuity income or your simplified accumulation annuity income 20, 30, and even 40% using previously unavailable strategies. So that's 4 steps that we'll talk about and how they all fit together.
All right. And I think it's interesting, you talked about protecting the downside and so on and so forth. It was just a few years ago, to be honest, that I was told something with very simple math, which was very helpful for me, but that when you lose in the market, it takes much more to come back, because a lot of people think of it as just an easy math equation. If you have $100,000 and you lose 50%, the market drops 50%, you have $50,000. Well, if the market comes back up 50%, you're doing fine. No, that's not how it works. If it comes back up 50%, it's only 50% of your 50, which is 25. So now you're only at 75,000 instead of that 100. So even though it came back up 50%, you're still way down. And that's a lot of people think, well, if the market comes back, my retirement account will be the same as it was. And that's just not the case. And so it's kind of retraining that thinking. And I know that you guys are eliminating fear with these actions. So let's go through these and the steps that you're doing with your clients. But people need to be thinking about talking to a professional like you so that they can protect themselves from that downside and not have to worry about the steep climb up.
That's an excellent point. We call that the dark side of compound interest. People don't realize that compound interest works for you in a good market and against you in the bad market that you just brought there. So even with your 50, on your example, even with that gain back up, you're still 25% down. Mm-hmm. And that's why market averages of the market are very hard to calculate. You have to really look at the real numbers. I have this client, it made me think as we were talking here. And to kind of illustrate the point, he calls me always at 5 o'clock. He's had this client for a couple of years now, and he always asks me at 5 o'clock, how come, and he's got one of these simplified accumulation annuities, how come my account's only up, 8%, the market's up 12%? And first of all, nobody's 100% in the market, so that makes it kind of a sad assumption. But what we're looking for is safety. Then the next year he called me and he said, the market's up 8%, how come I only got 6%? Well, this year when the market was down 30%, guess who didn't call? He says, I understand. I understand. I understand. And what John and I always preach for, at least portion of your funds is if we just hit singles and doubles all the time and you never go backwards, even these smaller gains, and we're not, still 5, 6, 7, 8, 9%, you still get way ahead if you never go backwards. And that's one of the things we try to get through to our clients.
Yeah.
John used to always say in our last little seminar we were given here, he says, we always say, we knew this was coming, and yet we never
never did anything about it. And what we're talking about is really just getting out of the way of yourself.
We know this correction's coming. But you ask everybody, they know it's coming. Then it comes, and they act surprised. It's kind of funny.
Yeah, yeah. And I've been talking to advisors as a consultant and a coach for many, many years, and they've all said the same thing. We know the correction's coming, and we know it's going to happen, and so I'm preparing my clients for it. But yet, again, a lot of people were caught off guard, even though it was very easily predicted, just we don't know the timing of it. And that's always the scary part, because nobody has a crystal ball, and you guys certainly don't. But you prepare as though it's going to happen, because we know what goes up must come down at some point.
Well, exactly. That's why our clients didn't get caught on this. Why we weren't prepared for this event. We were prepared for something like this. So the money that we had exposed in the market that did go down, that wasn't the money that our clients needed to draw on in the near future. So they can ride this. The market is great for growth. I mean, I'm always going to tell you that. It just depends on your timing and when you need it. You just can't tell you when you're going to get that growth. And so that's why when John mentioned too, we want to position some of these funds where when the market comes back, we take advantage of it. That's the problem with CDs and money markets. I mean, I've got clients call me up, say, I got $300,000 in my checking account. I know that's too much, but I don't know where I want to put it because I don't want to lose it. And this might be an alternative for them.
Yeah, because there's 4 investment strategies that really aren't working any longer for this environment for various regions, and that's CDs and money markets, bond funds. They're having a hard time keeping up with inflation. So if you have your money in these instruments, you're going to miss the bounce back when it does come back.
Yeah, absolutely. And that's just it's so strange for me, at least as a consumer, to see CDs and things that you're making so little that you're actually losing money, in my opinion, based on inflation. It just seems weird.
Right. Yeah, everyone remembers the old days. You make it 6%, you just peel off the interest and leave the principal, and that was doable. Now at a 0.5%, 1%, I mean there's nothing to peel off.
Yeah, it's like savings accounts at banks. They offer squat, for any type of interest rate. So why use those? But again, that's a subject
and then you
for
use
another
that,
day.
you utilize that for the volatility. We call this reverse dollar cost averaging. And we have volatility. We're taking out fees. We're taking out our 4% income, and then we're taking out the fees again, and it just snowballs. And all of a sudden, you've eroded your principal. And that's a subject for another day. But a reverse dollar cost averaging does happen very rapidly in a volatile market.
So I don't know about anybody else in the audience, but I like concrete examples. Do you guys have another example that you can share with us of how this has worked and with a specific client maybe that you can kind of convey what the steps were and everything?
Yeah. So we have a few of them, but one we'll just use. This lady came to us after her retirement, and she had $1 million, which was very respectable, and her advisor prior to us told her she could take 4% out, so that's your $40,000, okay? And she had what I would call a moderate risk investment, probably 60% equities, 40% stocks. But when the market does what it does now, okay, and I don't remember her exact numbers, and for compliance reasons, I got to be careful here, but her account was down like 20% the first year of retirement. I mean, this stuff happens, and people forget that, just because the market's down, in her particular case, she didn't stop living, so she needed to take her income. And, $40,000, given what she's been told her whole life, didn't sound unrealistic on that principal balance. But, that's obviously going to just start bearing. That's why I said the first 10 years of retirement, are so important. She had 2 years in a row that were down. So, she had lost in her particular example, she lost about 30% of her portfolio in the first 2 years of retirement. Wow. This is not a feel-good. We want our clients to spend with confidence. I can't stop the market from doing what it does. Market goes up, market goes down. But we want to make sure that we don't need to be pulling from it when it's down, if it's at all possible. That's really what we kind of focus on. So in her case, once we got her, and if you just kind of go backwards with the math, you can't do that in her case. But, if she just took no loss those first 2 years and just took out her income, and then with the corrections, the market came back, she'd have been fine. She's doing okay now, but it took a really rosy retirement and kind of threw a wrench into it.
So what specifically did you do?
Well, we took a big portion of her funds and removed it from the market. We like the simplified accumulation annuity, and what that does is allow us not to lose any funds in the market due to market decline. In most cases, there's no fees. So you have no fees and no risk. So when we draw income from that, it's not, we're not compounding that with the market losses and the fees on top of that. So that's what really solves the problem for most people, so that her other funds can grow unmolested. They can grow as the market grows, and we don't need to be pulling from it. So we're not trying to make more return with less money. I mean, if you think about it, it's like a death spiral. We lost some funds, so should she get more aggressive to try to make those back? Well, if the market goes her way, that might work. But if the market goes the opposite way, you're taking more and more risk. And that's what we see when people come into our office, that I don't think they realize, even bonds these days, to get a good yield, you're in high-risk bonds, high-yield bonds, I should say. So they may be taking more risks than they think they are, just because they need to get some decent returns, and it's hard to get. So this is one of the approaches. We also like, kind of the bucket theory, where we separate risk. So everything is kind of isolated here. So if one of your portions of your funds aren't going sideways, it's not affecting your whole portfolio. We prepare for that in advance because, as John said, I can't see this market. I don't know when it's going to do what it's going to do, but I can prepare for regardless of what it does.
So let's back up to the example that you gave. Let's say that she came to you with that full $1 million. She hadn't lost anything at that point. How does this simplified annuity compare to her previous advisor's plan of just taking out 4%? Besides, I mean, obviously I know that you say that you're eliminating the risk because of being able to put it into this, but as far as the income, is she still going to be able to get that $40,000 a year roughly?
Yeah, absolutely. And it's obviously it's a combination. I wouldn't suggest they put all their money into anything. And I wish we could turn back the clock for some of our clients here. But the reality is, if she had got to us earlier, or at least before this happened in the market, what we would have done is kind of separate this. If 40,000 was her goal, rather than saying the 4% rule, we would have solved for 40,000 to make sure that money is coming in regardless of what happens. That would not require her entire portfolio. I would never recommend that. The other part that we do that's just part of that, part and parcel, is that you want to make sure there's money set aside for emergencies. And then there's more of a growth component. Right now, if you just have a good old-fashioned 60-40 portfolio, to me that's all growth. Even though it's moderate maybe in risk, it's how do you pull a number from that? The market's not designed to hand you a paycheck every 30 days. So what we want to do is actually solve, and I would use the simplified accumulation annuity to solve for the income, because that's where it shines. So that would give us the guarantee there. And then use the stock market for what it does well, for growth. Here's what happens. Stock market does well, we take money from the stock market. Stock market's having a down year, we use the simplified accumulation annuity because we know we're not going to lose a penny due to market decline. They ping pong off themselves beautifully. If the market's up, you have your choice, because the annuity will do well and the stock market will do well. It's a win-win situation. That's why I like it. So what we really try to avoid is going to our stockbroker portfolio when the market's down. That's just it. We don't want to be forced. We want to take withdrawals on our time, not be forced to take it at a bad time.
Yeah, that's man. I mean, that changes the entire game. I mean, I'll be honest. It's shocking to me, because anybody who's kind of going by that quote, and I'm using air quotes on a podcast, my favorite thing to do, that 44% rule, right? That means you can never touch the principal. You can't touch it because you have to have it. You hope that it grows, right, with the market. And that's exactly what this is talking about. But you can't touch it because you have to allow it to grow enough to continue to take that 4% off. It's not like it's going to be 4% and then it's your portfolio is always going to be down. You're hoping it goes up so it covers what you've taken out. But that means you can never touch the principal. It sounds to me like with this solution that you have some possibilities with this other money. So if maybe you're charitable, you have the ability to do things for charity that you never thought possible, because you certainly couldn't give a lot to charity out of that 40,000 that you're drawing every year. You can give a little bit maybe, but that's just not a lot. But with those other funds freed up that aren't in the simplified annuity, I mean, college planning for grandkids. I mean, there's so many different things. Maybe enjoying your retirement a little bit more. I mean, that's huge.
Well, that's it. And if anybody's still looking at the 4% rule, I encourage you to look at what Morningstar or the Wall Street Journal says about that. And bottom line is, they say the 4% rule is dead. It just doesn't work anymore. At least not in this market, not at this time. And that's what we're looking for. You got to stay ahead of the curve here, otherwise you're going to have problems. And you're absolutely going to spend some of your principal in retirement. I mean, that's part of what that money's there for. But we just don't want to spend it as so quickly as to run out before we're ready.
Yeah, absolutely. I like my parents being able to have the freedom to go eat out every once in a while and not have to worry about, can we actually even go out to eat this month? There's all sorts of things to consider. I know that healthcare is a major issue, and we'll address that in a future podcast as well. But healthcare is a major issue. Everybody spends more as they get older. I certainly have, and I'm not even close to retirement age. But it's just a fact of life, and being able to plan for those things. I think is obviously it's vitally important. You guys are big believers in creating a plan and having goals and sticking to them. How are your clients receiving this? I mean, it sounds like pretty doggone good news to me.
Well, you just mentioned it, and that's the first thing I mentioned, and that's what we're all about. It's a plan. I can go through all sorts of vehicles and instruments and tools we have to help solve the problem. But first of all, we have to find out what the client's goals are and align it with what they're trying to do. So we believe in goal-based performances. I'm not driven by interest rate. I think if you're chasing returns, you're going to shoot yourself in the foot. That's my personal philosophy. Yeah. So that's why when we give these examples, it's nice to give an example, but there's so much more. What about taxes? What about, you said, healthcare? A lot of these, what we do in our planning is incorporate it so that whatever we recommend solves numerous problems. So we're going to help you with that tax situation, why we save some of your money, why we show you where you're going to access funds for long-term care should you need it, or home health care, which is way more popular. Everybody wants health in their own home, and so do we. That's what we want for our clients. So we show them some different strategies so they can accomplish that.
Now, guys, I know just through working with you that your company has multiple arms, right, of your company. You have specialists in a lot of different areas. I know specifically you have a specialist that helps you plan with your clients and helps your clients with Medicare and some long-term planning issues, correct?
Correct, yes.
Okay, so I'm going to ask a big favor. As part of this solution series, can we get your specialists on the podcast with you so we can have a conversation about it? They can kind of talk to the audience about what they do and how they do it?
Yeah, that would be a great show at that point in time.
Yeah, I think that would be something that a lot of people need to hear, a lot of people need to understand more about. I think there's just too much misinformation out there, and God bless Google and Google search. I use it all the time, but it's just like, trying to diagnose yourself. I've got a cough. What is it? Well, apparently, according to Google, I'm going to die in 3 days, so I've got to make some plans. But, there's so much information out there. I think it'll be best to have a professional come on with you guys as the professionals that coordinate this entire team and really answer the questions that need to be answered. But for today's podcast, we're running short on time. I'm going to ask you guys for some closing thoughts.
Well, it wasn't raining when Noah built the ark. 90 days ago, everyone thought that the market would continue going up and up and up. And then in the back of our minds, we all knew that correction was imminent. And then what happened? It caught people off guard and it crashed. It's come back a little bit since, but the question is, will it happen again? And I don't know, folks, but now is the time to make sure that it doesn't happen to you during your retirement again, and to protect yourself from the downside.
Absolutely. Guys, I think that's the way to end the show. How do they reach out to you if they have these questions and concerns and want to learn more about the simplified annuity?
Simple way is to either go to our website at www.crisfinancial.com, or you can email us at john@crisfinancial.com. That's CRIS Financial.com. Or you can call us 281-665-3081. 281-665-3081. Either way is a good way to reach us. We have a lot of valuable information on our website, articles and things that would be of interest. And then the contact us page would be on there to reach out to us.
Perfect. Thank you guys so much for your time today.
Thanks, Eric.
Thank you, Eric.
You betcha. And the last thank you always goes to you, the listening audience. Thank you for tuning in and listening to the Well-Rounded Retirement Podcast with Jim Donewald and John Glowacz. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Jim and John come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at CRIS Financial, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Well-Rounded Retirement Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of CRIS Financial. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your investment planning.